Welcome back. I'm glad you're here. Chapter 5 covers a topic I've grown to really like, although it wasn't always that way. We started a discussion about merchandise inventory back in Chapter 4. What you may not have known is that accounting for inventory is much more complex than simply determining its initial cost. Of course, right? Because most companies find it close to impossible to account for every individual widget or part they buy and sell. GAAP allows companies to select a cost flow method to make accounting more efficient while maintaining consistency. Companies are also required to evaluate whether inventory is worth less than the value on its books, deal with transactional errors, and evaluate obsolescence. So as a result, accounting for inventories is one of the more dynamic subjects in this course. Also, please make a note that we will not be covering Appendix 5A or 5B in this course. Now let's get started. As we've discussed previously, please review these learning objectives as you progress through the chapter to ensure you're on track. You will also find them in your chapter checklist. So first of all, which items should we include in inventory? Merchandise inventory includes all the goods that a company owns and holds for sale. And this rule holds true regardless of where goods are located when the inventory is counted. Now, certain types of inventory require special attention, including goods in transit, goods on consignment, and goods that are damaged or obsolete. So your textbook covers each of these items in detail at the beginning of the chapter. Please be sure you understand the rules for each of these three alternatives. And secondly, what costs belong in inventory? Well, here's a simple rule. The cost of inventory includes any cost that is necessary and reasonable to get the inventory to the buyer's place of business and to get it ready for sale. We already know that the invoice price and transportation costs are included in the total cost of inventory. Other costs to include are insurance, storage, tariffs, etc. So any purchase discount or allowance received also, as a reminder, reduces the cost of inventory purchased. How do companies know that the inventory reflected on the balance sheet actually exists? A number of events can cause the inventory recorded in the ledger to differ from the actual inventory in the warehouse, and such events include theft, loss, damage, and fat finger keyboard errors. Thus, nearly all companies take a physical count of inventory at least once a year and usually much more frequently. Theoretically, the physical count should match the number of items in our inventory records, right? But in reality, this is rarely the case. The physical count may not match our records due to spoilage, breakage, damage, obsolescence, and theft. So when a discrepancy between the physical count and our own records exists, it's brought to the attention of management, we research it, and an adjustment is made to correct our records. We discussed the adjustment required in Chapter 4. This physical count is used to adjust the inventory account balance to the actual inventory available. As you might imagine, accounting for inventory is not as simple as recording the journal entries we discussed in Chapter 4 then. Companies have to make several decisions about how to account for inventories. One of the key decisions management makes is determining the per unit cost assigned to inventory. As we'll see, this decision affects how much inventory is matched against revenue when inventory is sold, and how much cost remains on the balance sheet. In this chapter, we will learn about 4 costing methods to do so and how to calculate them. Now, secondly, a company must decide how frequently it wants up-to-date information about inventory and gross profit. Companies may select either a perpetual or a periodic inventory system. In short, the periodic system waits until the end of the period to compute cost of goods sold and ending inventory. The perpetual system, on the other hand, requires detailed record keeping, but also updates inventory quantities, cost of goods sold, and gross profit every single time an inventory sale occurs. Specific considerations about these types of systems are included in your handout on the next couple slides. Now, this course will cover accounting for inventory using a perpetual system. That means inventory records are updated continually for every purchase and sale of goods. While this method used to be very time-consuming due to all the details involved, inexpensive technology has made it much more common. So let's go look at that periodic system on the next slide. Well, I would like you to know what the difference is between the perpetual and the periodic systems. We won't be covering the periodic approach in this class beyond what I've included on this slide and what's in your textbook. Periodic systems are addressed in Appendix A if you would like to investigate further. As a reminder then, the journal entries we learned in Chapter 4 record the purchase and sale of inventory. Do you remember what they are? Hopefully, yes. They are shown on this slide. Debit merchandise inventory credit accounts payable for the purchase, and we have two entries for the sale of inventory. One to record the sale price times the number of units, the second to record the cost of goods sold, which is the cost times the number of units. It is really important that you are completely comfortable with these entries before you complete this chapter. Now, as you recall from Chapter 4, inventory is reported either on the balance sheet or on the income statement, depending on whether it's been sold or not. Let's take a closer look at the relationship between ending inventory in the balance sheet and cost of goods sold in the income statement. We'll need to understand this relationship as we start our discussion of costing methods, and we'll use a really simple example for a local Best Buy. Assume the store begins the year with $20,000 worth of DVD inventory, and that amount represents how much Best Buy spent to purchase the inventory of DVD players on hand at the beginning of the year. Now, during the year, the company purchases additional DVD players for $90,000. So the cost in total of DVD inventory available for sale is $110,000. $20,000 from the beginning inventory plus $90,000 purchased during the year. Of the $110,000 in inventory available for sale, assume that by the end of the year, the purchase cost of the remaining DVD players not sold equals $30,000. This is the amount reported for ending inventory. If $30,000 of the inventory available for sale was not sold, then the remaining portion of $80,000, which is 110 minus the 30, was in fact sold and will be reported as cost of goods sold. I hope this makes sense. A challenge then exists when it comes time to decide on how much cost should be assigned to each inventory item sold, because the cost of each inventory changes over time. The complexity arises when we purchase inventory items at various prices. When we start to sell inventory, we must decide how we will associate cost with each item sold. For example, we may purchase several inventory items at $10 a piece, and the next time we need to purchase the same item, the cost may have risen to, say, $11 each. And then when we sell any of these items, we must decide if we will record cost of goods sold equal to the $10 cost or equal to the $11 cost or to some other cost between the two. So it's very inefficient generally and sometimes impossible to accurately track which cost attached to inventory items sold versus inventory items still on hand. And to address this issue, companies use cost flow assumptions to allocate the cost of goods available for sale to the income statement as cost of goods sold and to the balance sheet as ending inventory, okay? So note that if we allocate $1 more in cost to the inventory sold, we must allocate $1 less to inventory on the balance sheet. Thus, there is a direct impact of our cost flow assumption on net income and on total assets. And as an aside, this concept of how costs are allocated between ending inventory and cost of goods sold also holds true when we discuss inventory errors later in part 4. So please make a note to yourself about it for now, okay? Well, that's it for now, and we'll move on to inventory costing methods in the first part of part 2. So I'll see you in a little while.